Welcome to The Explainer. Today, we're going to pull back the curtain on something that feels like one of the market's biggest secrets, but it's actually incredibly simple. We're talking about the powerful logic behind supply and demand trading.
Okay, let's just jump right in with a number that, well, it might completely change how you look at the market. See this? 95%. That's roughly how much of the trading volume is controlled by the big dogs, the major financial institutions. It's not retail traders like us.
So, that leads to a really important question, right? If these institutions are the ones with all the power, the ones literally moving the market, why are we trying to trade against them? It doesn't make a whole lot of sense, does it?
And that right there, that's the whole idea. See, a real edge in trading isn't some super complicated secret indicator you have to buy. It's much simpler. It's all about learning how to spot the footprints these giants leave behind on the charts.
I mean, when you really boil it all down, the entire strategy is just unbelievably simple. You just have to figure out where the smart money is buying and where they're selling, and then you just follow their lead. That's it.
Okay, so that's the plan. But how do we actually see these footprints? Like, what do we look for on a chart? Well, it all comes down to understanding that the market really only exists in two basic states.
So here they are, a tale of two market states. First, you've got a balanced market. This is where the price is just kind of drifting sideways. Buyers and sellers are in a deadlock. It's a period of indecision. But then you get an unbalanced market. This is where one side takes complete control and the price just explodes up or down with total conviction. The magic happens right where the market flips from balance to imbalance. Those spots are what we call zones, and they're the clues we're hunting for.
And here's a great way to think about it. That balanced, sideways area, imagine it's the boardroom of a massive institution. The big boss is in there with his team, and they're deciding, is there more juice left in this stock? The decision they make in that boardroom is what creates the next huge explosive move.
And these big decisions, well, they show up on the chart as four very specific patterns. These are the literal footprints we've been talking about.
All right, first up, we've got a classic reversal pattern, the rally base drop. So price is rallying up strong, right? Then it hits this base area, a pause. That's where the buyers finally run out of gas, and bam, the sellers take over and cause a sharp drop. It's a complete shift in power.
And of course, you've got the exact opposite, the drop-base rally. This time, price is in a freefall, a strong drop. It pauses in that base at the bottom, and then, boom, powerful buyers step in and completely overwhelm the sellers, causing a huge rally, another total trend reversal.
Okay, so those were reversals. But what happens when the trend just keeps going? Well, those are called continuation patterns. Take the rally base rally. The price is already in an uptrend. It pauses for a second in that base, but it's not a sign of weakness. It's more like the buyers are just taking a quick breath before they reassert control and push the price even higher.
And you probably guessed it, the drop-base drop is the bearish version of that. The market is in a downtrend, sellers are in complete control, they pause for a bit in that base, maybe to consolidate their positions, and then they get right back to business pushing the price lower.
So you're going to start seeing these zones everywhere on the charts. But here's the thing, not all of them are created equal. The pros, they're really good at ignoring the noise and only focusing on the really high probability ones. So the big question is, how do you spot a truly strong zone?
Well, there's a pretty simple three-point litmus test you can use. First, you need an explosive move away from the base. I'm talking fast, steep, powerful. It shows the institutions didn't just nudge the price, they shoved it. Second, the base itself should be tight and compact, made of just a few candles. This shows they were decisive, they didn't waste any time. And third, this one's important. You want to see a quick return. Why? Because it tells you they probably didn't get all their orders filled on that first big move, and they're waiting for the price to come back to them.
Okay, so you've used the test, you've found a strong-looking zone. Awesome. But now comes the part that really separates the amateurs from the pros, knowing exactly when to pull the trigger.
So when that powerful move happens and the price just takes off, is that your entry point? A lot of traders see that and get a serious case of FOMO. They jump right in. But is that the smart play? Absolutely not. And this quote says it all. Never trade a zone that's still under construction. You have to remember, that first explosive move, all it does is create the zone. It is not a signal to trade, not yet.
The professional strategy is all about patience. You wait. You let the price do its thing and come all the way back to the zone it just created.
That return trip, that retest, that is your confirmation. That's the market telling you, yep, those big orders are still here and they're ready to defend this level.
All right, but what about when things go wrong? What happens when a zone doesn't hold up like you expected? Well, believe it or not, this is actually where you can get some of the deepest insights into what the market is really doing.
In this situation, time is everything. A really strong high-probability zone will get defended almost instantly. You'll see a sharp reaction. But if the price comes back to a zone and just sits there, if it starts chopping around and spending too much time there, that is a massive red flag. It's a sign of weakness. It's telling you the big players have either lost interest or, maybe all their orders have been filled.
And this weakness often leads to what's called a role reversal. When a demand zone breaks, it can flip and become a brand new supply zone. Basically, a former floor can turn into a new ceiling. And the same is true in reverse.
So when you really think about it, a zone isn't just a price level on a chart. It's a story. It's the story of a battle fought between institutions. And the question you have to ask yourself is, are you reading that story correctly? Because your job isn't to guess or to fight them, it's simply to understand their story and trade right alongside the market's real movers.